Welcome to the 5 and 5 option trading series. We're making 5 videos over 5 days, roughly 5 minutes each, to teach you about option trading. This series is being created by the Weekly Option Podcast. You can find us on iTunes, on Google Play, on Stitcher, and on a few other podcast directories. Each week, we explain 3 new trades that you can add to your account this upcoming week, and we also discuss the results of the trades from the last show. So it's great for beginners, intermediates, and people who are just thinking about trading options. Today we're going to discuss calls and puts, and to keep this under 5 minutes, I'm going to have to really push through. So let's get started. Call options. Call options give the purchaser of the option the right to buy 100 shares of the underlying stock at a strike price of the option on or prior to the expiration date. The seller of the call option has the obligation to sell 100 shares of stock at the strike price on or prior to the expiration date, and the value of the option increases when the price of the underlying stock goes up. Now, if you buy a call option, if you're the purchaser of a call option, that means that you expect prices to go higher. You're bullish the underlying stock. The buyer will need the stock price to rise more than the cost of the option plus the strike in order to make money from the purchase. Now, here's the risk in buying a call option. The purchaser of the call option will never lose more than the amount that was paid for the option, which is great. The owner of the call has a cap downside, and that downside is only the amount of money you paid for the option. But they have unlimited upside, similar to owning a share of stock. If the stock goes up indefinitely, that option's value will go up indefinitely as well, as long as it happens before the option has expired. Now, it changes a little bit for the seller of a call option. So the seller of a call option is actually bearish the underlying. You would only sell a call on a stock that you expect to go down. The seller will need the stock price to stay below the strike price plus the premium collected for the option in order to profit. The seller of the option actually receives money at the start of the trade rather than paying for it. They actually receive money. And here are the risks of selling a call option. And you've got the payoff graph there as well. So the seller of the option has a capped upside potential. They'll only ever make the amount of money that they collect when they sold that option. However, the seller of the option has unlimited risk because, in theory, there are not any caps on how high a stock can go, and that seller will be responsible for the upside of that stock. So that's a quick one on calls. Let's jump into put options as well. So put options give the buyer of the option the right, but not the obligation, to sell 100 shares of a stock at a specified price prior to expiration of the option. The seller of the put option has the obligation to buy 100 shares of stock at the strike price on or prior to the expiration date. So puts increase in value when the stock price goes lower. Now, it's sometimes hard for people to wrap their mind around put options, so I like to compare it to car insurance. If you do not have an accident, car insurance has no value at all. The insurance policy will fix the damages, thus restoring the losses if you do have an accident, so any damage it covers. This means that the insurance policy's value to you, the buyer, increases when you have an accident. So when your car's value decreases, the value of that insurance actually increases to you. And just like a put option, it has an expiration date. If you don't pay your insurance on a monthly or on an annual basis, that insurance policy expires just like an option will. Now, the buyer of a put option is bearish the underlying stock, meaning they expect it to go lower in price. And they'll need the stock price to fall more than the cost of the option minus the strike price in order to make money from the purchase. The purchaser or the buyer of the put option will never lose more than the amount that was paid. The owner has a cap downside, right? The amount that was paid for the option, and a maximum upside of the strike price value. Now, the seller of a put option is actually bullish, the underlying. If you sell a put, you actually expect stock prices to go higher. You will need the stock price to remain above the strike price minus the premium that was collected for the option in order to profit. And the seller also receives money at the start of the trade. So the risk of selling is that the seller has a capped upside potential. You'll only make what you sell the option for, but the risk is actually equal to the strike price of the option itself, because a stock can never go below zero. So basically, if you sell, in the example, if you sell a put option with a 35 strike, then $35 is your risk. Now, if you have any questions, they might be answered in the next video, but feel free to visit our webpage at www.theweeklyoption.com, or you can email me directly at eric@theweeklyoption.com. Look forward to seeing you over at day 2 tomorrow, where we'll discuss covered calls and naked puts.